Hi guys, thank you very much for joining. Popping on a little bit early. I can see the people still joining now, so we're going to get kicked off very soon. Just want to jump on and say hello in this Christmas period. So hope everyone's had a good time, good Christmas, and a nice break. So we're going to be talking today about investor resolutions in 2023. So some really good content to cover actually, and some stuff we've been discussing in the office for the past couple of weeks. So yeah, I'm just going to put it on pause while I get everything set up in the background, and then we'll jump into this. Thank you. Hi guys, we're a minute away from starting. See John's just joined as well, so he's on. I'll introduce John shortly. But yeah, just a quick hello from myself. I can see there are people still joining the room now. So as I mentioned earlier, thank you very much for joining us during the Christmas and New Year period. Looking forward to having a chat and talking to you about options and ways that you can structure your investments for the new year and kind of delving straight into it. So we're just going to give it another minute and then we'll get started. Great stuff. So yeah, so I've just put my video on. I'm going to turn this off shortly so we can do the full webinar, but massive hello. My name's Stephen Moss. So yeah, I just wanted to say a quick hello so everybody kind of knew who they were talking to before we jump into the webinar. I'm going to turn the video off now. I can see we've got a few people still joining the room. A couple of names that we know already. So hi guys, good to see you. Thank you for joining us at this time through the New Year period, between Christmas and New Year. Hope everybody's had a nice Christmas, relaxed and getting recharged. And you know, we kind of thought about when we best do this webinar, and we thought it was a good idea to do it between Christmas and New Year, given that it's the time, you know I sit down and kind of look at what the plans are, where we're going to invest, what we're going to do as a business, and strategize. And I'm sure everybody else is the same. So yeah, we're going to jump into that now. So yeah, so let's get started with the webinar. I can see there are a few people still joining, but I'm sure they'll pick up as we kind of jump into it. So this webinar today is presented by Source Capital, and it's all about investor resolutions for 2023. We're going to kind of expand on what that means and what we've learned throughout the kind of years for what we're doing. So I see someone's just raised the hand there. A couple of people still joining. We are going to get to a point. There's going to be different points about questions, so we'll touch on that very soon. If there are any problems in terms of, hopefully you can hear me. I have tested it, but if there aren't, please feel free just to put a chat or a comment on there so I can jump on and check the technical side as well. So let's jump in. First of all, this is presented by myself, Stephen Moss, and I'm going to introduce my colleague, John Wilson. A bit of an introduction about me. So I have been in the property and investment sector for over 21 years. I'm the managing director and founder of Source, so the Source Group. I'm going to introduce you shortly to who the Source Group are and what we do and how we differ. And also what kind of gives us some kind of experience to sit here and talk to you about investing in the new year and what the opportunities are. Personally, I'm a property developer. I invest in different types of structures, strategies, always looking for new ideas, new ways of doing things. Like to be as tax efficient as we possibly can as a business and as a personal investor. So I utilize lots of different strategies, and that's some of the input that we've put into this presentation to talk to people and show them as well. Some of my kind of achievements. So as a business, we've got over 170 franchisees, which I'm going to touch on shortly. We're developing sites. We've got a pipeline of about 40 million, but we're developing sites and build a portfolio of about 50 million. So quite large structures across the UK, dotted right from Bournemouth all the way up to the Scottish border. So a good kind of mix of actually what's going on in the UK from a property point of view, but also one of the biggest benefits we have in the business is we speak to investors every single day, so we get to get a really good understanding from it. I'm going to introduce John, who's going to give you an overview of his role and his experience, and then we'll jump into the next stage.
Hi everyone, hope you can all hear me. So yeah, I've been at Source for what, three and a half years now. So I started at Source as the investor relations director, following a relatively short investment journey with Source beforehand. and Steve offered me a role with Source. But before that, I've been an investor for 10 years now, looking at different asset classes, looking at different methods and different modes of investment, purely to earn a return for myself. And I'll run through my personal goals for 2023, or a very brief outline of those. But also, the reason why I put this webinar to Steve last week was a lot of investors that I speak to often have these conversations in January of, I've assessed what I'm looking to do in 2023. This is what I want to do. John, can we have a look at how we can best position that? So I wanted to give a few tips and tricks that I pick the brains of investors for, and what I've learned over the last 10 and a half years.
Fantastic. Looking forward to seeing those points and seeing what opportunities there as well. So let's jump into it. First of all, before we get into the actual webinar, some important information for anybody watching. This webinar is not financial advice. During this webinar, we will look into investment opportunities from Source Capital. These opportunities are for sophisticated and high net worth individuals. Your capital is at risk and you may lose all you lend. Peer-to-peer investments are not covered by FSCS. Legal charges secured against UK property. Property values may go up and down. Investments are illiquid. So I think it's very important that you kind of understand the type of business that we are and who we are personally, and how we speak and deal with investors. We're very upfront and very transparent, and it's important to have a relationship that way. I mentioned earlier about asking questions, so feel free to ask questions throughout the presentation, regardless of what slide we're on. You've all got the functionality to fire a question over. If there's any questions that you've got that are more personal, or you'd like either a call or to drop an email, our contact details are at the end as well, so you'll have that ability to fire something over, and we're happy to talk about personal circumstances or anything we can do to help. John spends 99% of his time speaking to investors, understanding what their strategies are, their needs are, and how we kind of fit in and work and help there. And having that kind of soundboard, I'd use it as it is great, because he comes across lots of different types of investments that people discuss with him. First of all, I'd like to introduce you to Source, so the Source Group. We're split into 4 divisions, if you like. I'll start off with the franchise one, because it's probably a little bit easier to explain. So the business started as a franchise network. We have over 170 franchisees across the UK. Our franchisees are supported and trained to find investment opportunities. When they find an investment opportunity, typically they've got 2 options. The first option is to package and sell that to an investor, and that would typically be passed over to our property team, so Source Property. Our Source Property team work with investors. They'll introduce the properties to them. We have a phone app. If anybody's not seen it, if you search on Apple or Google Store, you'll find that we've got on the Source Property, we've got a phone app which is free, and basically deals are just posted on there every day. So if you're looking for properties, it's a great place to have a look at. If the franchisee decides not to sell a property and to do the property themselves, then it comes over to our capital team. So Source Capital is an FCA regulated peer-to-peer lending platform. The property will go through our credit team, and at the point of once they've got all their reports in and they've got all the information together, they'll then put that onto our platform for investors to invest into, raise money for the project and to be purchased complete, and either resold or refinanced, and everybody repaid back. If the project's a little bit bigger, or the franchisee doesn't have the experience, then the option is to joint venture with head office, and that's where our final team come in place, which is our developments team. And we work with the franchisees to do a larger scale build, so whether it's new builds, conversions, those sorts of projects. So I mentioned at the very beginning, kind of giving people an insight into my experience. This should hopefully kind of explain how we're kind of really tied into investments, property, and not just locally, but right across the UK, to give us a real flavour of what's going on, what's happening in the market, what people are reacting to, and how we're kind of seeing the market change, certainly in the new year. So yeah, little introduction to Source. Again, if anybody wants to find out any more information about how the businesses work together, or any particular information about a certain area, please feel free to reach out or fire a question over. We're happy to jump into them. But each part of the business work together in order to help them grow. So ultimately, if we've got more franchisees finding more properties and pushing them through, then there's more investment opportunities and there's more properties for sale. So it kind of all works together in a really nice kind of ecosystem, if you like. And that's really what we've kind of grown and pushed, and the basis that we're all working together to grow the businesses. So yeah, a little bit of an introduction. The main reason we're here today, and everyone's kind of taking a break from the mince pies, is ultimately looking at the title. So 2023 investor resolutions. So what are they, and where we're going to start with this? I think when we've talked about it in the office and talked about it with the team, it's always good starting off with what are the goals, where does that start? John mentioned a couple of minutes ago about he's happy to share his goals. This isn't a kind of high motivation, high press of goal setting, etc. But what this webinar is, it's important to acknowledge that these are part of the process, particularly when you look at next year. So I want to start off with John's in terms of the goals, John, that you're looking at for 2023. If you want, I'm happy to click the next slide for you.
Absolutely, there'll be two different points here. So yeah, when I first started investing, and probably up until 5 years ago, the main things that I looked on and focused on were returns. Every year I would set a goal of, I want to hit this return, I want to do this. Within quarter one, I want to achieve this. By quarter two, this. By the end of the year, I want to hit a certain either percentage or amount of income coming through. And it was extremely difficult. And a lot of the time, the goals that I set in place were quite out of reach. So some years I would do extremely well. That'll be a mix of utilizing the stock market, investing in cryptos, doing third-party investments. And over that time period, I started to realize that chasing my tail or chasing the next investment to get a higher return was extremely time consuming. It took a lot of mental effort. All of this while also working a full-time job in corporate life. It's difficult to attain. So my goals changed from purely being return set to looking at a number of different factors when it comes to setting the returns and what effectively I want to achieve throughout the year. So at this point now, I want my investments to be passive. What can I do to make my investments and my returns as seamless as possible? The next step for myself is I've got a massively diverse stock market investment portfolio. I need to consolidate a lot of that because I can't keep a track of, there's probably 50 different investment assets that I'm in currently, and it's very difficult to keep a track of all of them and what's happening. So I need to move into more of a managed fund on that side. I want to continue to recycle my investment capital. There's no major life events that I've got within the next 12 months that are going to put a halt on what capital I've got to invest. And again, that's part of what your structure may be for the next year. You might have certain things that are going to come up throughout certain parts of the year that you need to be mindful of and utilize what you can when you can. And if it means that you need to have downtime where you've got liquid capital, where you've just got cash either sat in the bank or sat idle, you may need to do that. Alternatively, if you have nothing that you want to hold back for, it may be that you want to get fully invested. And I want to continue to work with the trusted partners that I've worked with over probably the last 4 years in terms of doing a lot of third-party loans into property development. So that's a brief outline of what I want to do every year. Just before the new year, I'll go into a lot of these in a lot of depth and I'll add more to it, and I'll try and achieve those throughout the year.
Okay, fantastic. And the first thing I'm going to do, guys, is I'm going to fire out a quick poll to everybody just to say, because John's point there at the beginning is really important. Although John's talked about there that his goals were very much return driven, a lot of people are still that minded, and it'd be good to understand what people's goals are in terms of what drives that return, what are people looking to achieve, because I think that changes A, the older you get, B, the market that you're facing, and C, the more experience you get as well. So it'd be good to hear what everybody watching this is also looking to achieve as well. kind of listening then, John, to the sort of next stages, it kind of fits in really well with the areas we're going to touch on in the portfolio, particularly sort of reviewing things, looking at what's working, what's not working, and then pushing it forward from there. So I'm going to leave this poll open for another couple of seconds just to get some feedback in, and then we'll obviously publish it. I can see the results coming already. I mean, you know, it's quite a clear winner. It's quite clear that everyone on here is trying to make billions already, so that's good. It's a good start. Ambition, that's the word. So yeah, I'm going to stop this now. It's been on for a minute, so last couple of seconds, guys. If anybody else wants to just click on what they're looking to achieve, but we're going to close it off now. So to share the results with everybody, I'm going to click that button actually, so everybody gets to see this. So 83% of people who voted are looking to achieve 10 to 14% return on investment, which is good. And then we've got 17% that are looking for 15% plus. Now, normally when we've done these in the past, we do have a lot of people that are actually looking for 5 to 9%, and that was an option on here. So it's quite interesting to see that either we've got a group of people that are experienced and already partway through their journey, which is good because things that we can talk about, we can go a little bit more in depth, and we can answer some more good questions. But it's really interesting to see. And if you're completely new to investing, you know, that's great because you're hearing what other investors are looking to achieve, what their expectations of the market are, and it'd be good to see how they kind of follow them through and how we push it forward from there. So yeah, so a little bit of a poll. We've got another poll coming up later on, and again, just to share some data for everybody, because we've got a few people on this webinar. It's nice to know actually what your thought process is. It's the same and in line with other people's as well that are watching this. Me personally, when I look at goals, I kind of do it a little bit differently in terms of I set up pots and my goals are relevant to those pots. So I find that more manageable personally. So rather than having like a return overall, I'm a little bit more sort of granulated. So I look at different pots and I look at, you know, as a great example, it might be, you know, my son's car, it might be, you know, different areas. I'll set that pot up and that's one area that I'm investing to flow into that and what I'm looking to achieve from that. I also like doing it that way because I like to see the progress and I like to see those pots kind of build. So for me, it's a nicer way to kind of manage it and push it forward. It still means I go through the same process that we're going to talk about today, and I know John follows as well, but it's just how we might kind of manage those goals and what we're looking to achieve throughout the year. Let's be honest, we're all looking for the same. It's world domination and nothing else, but in the same way, you've got to step back and say, well, what's happening in the market? What's realistic? Where are the risks? Where are the challenges? And let's really kind of drive that down to make sure that, you know, there are less risks. We're more aware of what's going on, and ultimately we can hit those goals as well. Rewards are key. So I mentioned earlier, just mentioned actually about my son. So some people find, and this is kind of my experience of working with investors and working investments for the past number of years. Some people are quite happy where they set themselves a kind of investment goal, whether it's return or amount of money or whatever that factor is. And when they hit that, that's a big enough reward for them. I'm a little bit different. And to give you an example, I know my son's different. My son's just got his first job. He's looking at, right, okay, I've set up an investment pot. He's a savings pot. And his goal is, right, okay, we've been talking about the lifetime ISA so that if he can get to £4,000, he's got the opportunity there of you know, for his first property, use that towards the deposit, get this extra bonus from the government, which I'm sure everybody knows the scheme. And he's brought that down then to say, well, I'm going to go for £1,000 from the first pot, but when I hit the £1,000, I'm going to give myself a little reward. So he's going to get himself a football kit, and you know, there's different elements there, or he's going to go for a meal and things like that. I think that's really important to keep you on track and keep you focused on those investment goals. So again, some people work in different ways, but I find it quite useful to have those small rewards in places so that when you hit certain points, you know, you can celebrate it and you can have a focus, and it helps you sometimes refresh, step back and make some slight amendments to actually get better and better and better at it and continue to review. So some of the things that we've kind of come across and learning from over the years. Another key area, obviously, before you jump into the investment side is preparation. So one thing that we talk about an awful lot in our office is keep capital safe. And that's not just capitalizing our business, that's capitalizing the money that you're putting in. We talk about it an awful lot because people sometimes focus more on what the return is than actually what's the chance of getting the capital back. The comment that John's putting here, the return of capital is more important than the return on capital. It's making sure what you invest into, you're going to at least get your funds back, you're going to at least get, and then focus on getting that return. And people who have been investing for a long time will have this very, very focused because they'll realize that throughout the time they've been investing, there have been mistakes, there have been errors. It's about de-risking, it's about being diverse, it's about looking at alternative routes, it's about looking at what security comes with that investment, and taking all these different things into account and then applying them in your plan and in your journey to make sure you're keeping that capital safe. How often do investors talk to you about this, John? When you're looking at, when they're looking at investing, not just ourselves, but I know they talked about the different types of investments. Do you find as well, or it's just typically more experience?
No, I would say probably 95% of investors that I speak to have this type of conversation with me. It's a very common conversation to have because at the end of the day, that's your risk element, whether you're new to investing or whether you've built that pot up for a long time. If you lose capital, it's a lot harder to build that back up than it is to just invest that for a slightly smaller return. A lot of people think risk and reward, the more you risk, the higher return. It's not always like that. But if you lose 50% of your capital, you need 100% growth to get back to where you are. And not a lot of people realize that. They look at it as, if I lose 50% and add 50% back on, then I'll be exactly where I am. No, you'll still be massively down on it. So the return of that capital pot, the original invested capital, and keep that rolling time after time is a key element to any successful investment, really. And it should be something that's in the back of everyone's mind. If it sounds too good to be true, it probably is. And do your DD, make sure you're checking through reviews, speaking to other investors, starting to build that picture of that due diligence throughout whatever asset class you're looking at. And if you're brand new to investing in different asset classes, don't just wing it. I did that 10 years ago. I did well and then did extremely poorly, did well again, did extremely poorly. And as soon as I started to look at it from a bigger picture, everything became a lot easier and I'd no longer worry as much about the return of capital than what I did 10, 8, 7 years ago.
Yeah, no, it's a fair comment, absolutely. An interesting point I read about yesterday was more than 35% of people make their financial resolutions at New Year, so hence we thought it was a good time. Now, in 2022, 41% of people achieved their goals. It's not too bad, actually. I think if you were to guess that, a lot of people, particularly when we're discussing it in the office, a lot of people coming in a little bit lower, expecting actually, is it one of those New Year's resolutions that people don't achieve? But I think 41's quite good. 80% of people already set them for 2023. So what's showing is that actually people are hitting them and achieving them. And then they're already taking time out before Christmas or just before New Year to get them in place for the next year, which is good and promising for what's going to come in the new year. And kind of everyone's getting that crystal ball out, aren't they, hoping they can predict or out-predict what's going on. Some top tips in terms of preparation. So some of the points that we do as investors and as a business. So schedule yourself some quiet time, whether it's going out walking, whether it's just locking yourself away, whether it's going to Costa or anything along those lines, taking that time out is really important. Taking time to look at past performances. So if you're brand new to investing, and that's absolutely fine, it's understandable, but you can still look at what the past performance have been for the investments that you're interested in or you've been watching on YouTube or anything like that. Don't do everything in one session. I'd say that's a really big tip and something I've particularly learned, where I've kind of booked myself away for a day, really kind of brainstorm, whiteboarded what I'm going to do, what I'm going to achieve, how it's all going to fit together. And then when I've walked away, thought about it for a couple of days and come back, I've changed some really big parts of it. So don't be afraid to do that. Make sure you can walk back and change things and feel comfortable with it. And then be inspired. Look at what other people are doing. Look at what people are achieving, I think it's important to add there that don't kind of get lost in what other people do, because it's very easy to go on social media and see, somebody doing absolutely phenomenally well, or that perception of someone absolutely doing phenomenally well. 9 times out of 10, that's not reality, and I'm sure everybody will agree and understand that. But I think it's also good as well to identify, key channels, key focus, key gurus, if you like to use that word, but people actually share what they're doing, share their experiences, the good, the bad, the ugly, and get a really good understanding of it, because it's only going to help you. If you're watching somebody on YouTube or some social media channel and all you're ever seeing is the positive, it's not realistic. You've got to understand that with investing, there are periods when it will go down, and you've got to, either play the waiting game or change strategies and move things around. So just be aware of it. But in terms of preparation, look for things that will inspire you, look for ways that you can look to build.
Yeah, a key point that you mentioned there, and I've dealt with hundreds, if not thousands, of investors over the last few years, and the ones which are, I'd say, on the ball the most, the ones which know exactly what's happening with their investments, what they've got coming back at certain times, they are the ones that schedule time. So obviously we're talking about the new year in 2023. This shouldn't be an annual thing, even though it becomes that. It should be every month, every quarter. It should be looking at what investments you've got, what's performing, what isn't, taking that time to understand that, and then you're on top of the investment strategies throughout the year. And that's probably one of the key things really for investors that seem to be doing really well over the years. They take the time to just study what they're doing.
Yeah, I'd also say as well, a really good point there that you've raised. I mean, it's just made me realise that, like today I've had 2 calls, tomorrow I've got calls, because our top percentage of investors that, do other things, invest, they want to just pick your brains on things, or, it's a 5-minute, 10-minute call. It's never a long call, but ultimately it's a 5-10-minute call, and they probably do that with lots and lots of people to pull data in and understand it. And, don't be afraid to ask, to speak to people. If you're building a plan and you've got a particular area you're interested in going down, pick the phone up, drop someone a message. If you can find someone on social media who's either not selling something, but they're achieving it, then I'm sure they'd be happy to share their story as well, and have a look for those people. But yeah, definitely, it's a good point raised. Investing in 2023. So, one of the things that we've all got to appreciate is we've got to be a little bit realistic in terms of what can be achieved or what opportunities are out there. I hear a huge amount at the moment that, 2023 is going to be this enormous year where there's going to be lots of repossessions. There's going to be lots of, potentially there are, but putting all your eggs into one basket is obviously not smart investment, or investing, sorry. So it's important to be realistic with other types of assets and investments, and stepping back and looking at them. What is potentially going to happen next year? Are we going to enter that recession? We know tax increases are probably going to take a big role in repaying this money that's been drawn down. Look at market cycles. So market cycles, I went to a conference a couple of months ago, and they were talking about market cycles, and one of them was, a lot of people are gearing up for January, new year, new investment, hit the market really, really hard. However, the reality of it is that, in January, a lot of retailers closed down because they've taken all the monies over Christmas. They've had a great Christmas, and they know that they're not going to survive next year, so they'll close down. So we might see January, February, a lot of retail companies closing down, which means that there won't be this kind of explosion in the market. It will slow it down. It will take a bit more time, and it will kind of filter through. Inflation, how's that affecting what you invest into? We've seen this more recently with other peer-to-peer lending platforms. So some platforms that were offering returns of maybe 4%, 5% maximum, they're now stepping away from working with retail investors, because what's the point in offering somebody, 4 or 5% return when they can get close to from a savings account, but also inflation is wearing away at that. So, there's a lot of things to take into account here. Interest rate increase, how is that going to affect the market? Is it going to affect yourself when investing? Is it going to be property based or another format? And market fluctuations as well. Are we going to see this either correction or drop? We should have put that into poll really, John, because it's quite a good talking point, isn't it? What are people's expectations for next year? Because you're kind of hearing this huge range from Some people are expecting maybe 4% reduction in housing market, but some people are going as far as sort of 20%. Is that the media? Is that just trying to sell newspapers, etc.? God knows.
Yeah, it's interesting. You'll also probably get a few people that think the market's going to bounce back. Obviously, it's taken a bit of a slowdown. Mortgage rates have gone up. The market slowed slightly. So a few investors that I speak to think the market will bounce back next year and have a bit of a resurgence going into the new tax year.
Yeah, I've heard that from different investors as well. People, you can see some mortgage lenders have started to reduce some rates as well, which is signs that maybe the stability is there. But, again, this all needs to be taken into account when planning on what you're going to invest into and what options you've got available to you as well, and how you manage that. Balancing your plan. So it's important to look at your investment plan for next year and make sure there's balance in it. One of the areas that we look at for balance is, dividing your investments. So you'll all have heard of being diverse in your investments, so making sure you put, some in property, some in stocks and shares, some in different asset classes. We also then look at actually, what's short-term, long-term, and retirement. It would be good if anybody's got any kind of questions or thoughts on what they view these as. We did a webinar 2 or 3 weeks ago talking about short-term investments and the benefits of them for beating inflation. And the feedback we got from that was actually really good, really encouraging, because people hadn't realised how powerful short-term investment could be for beating things like that. And also, what do people class as a short-term investment? Is it 2 months? Is it 12 months? Typically in our sector, we class a short-term investment of 24 months. Longer-term investments are 5 years, 10 years. And then out of your investment plan, how much are you going to put into your retirement plan as well? So, that's typically based on A, what your pension currently looks like, B, what's your age at the moment, and how aggressive you want to be in that plan. Quite often, a lot of people retirement percentage, we see quite often where it's between 5 to 10% of their return goes into their retirement side. And obviously there are some real tax savvy ways that you can utilize your pension. So it depends on what kind of balance you're going to get there. Yourself, John, short-term investments, what sort of feedback do you get from investors when you're talking about short-term? Is there any difference there really from what we've discussed, what the points I've touched on?
Yeah, it's something that obviously we spoke about at length last week, whenever it was, last week, a couple of weeks ago on the last webinar. It's something that we'll delve into in a bit, but the power of short-term investing over a longer period is massive. It allows that flexibility. It allows a change of tax should you need it. And obviously you've got the compounding effect, which we'll delve into and talk a bit more about. But short-term to one person is different to short-term to another. So short-term investing for some investors might be swing trading. Every 3 to 5 days they're opening and closing trades. It could be that they're day trading. So a long time for them in their world could be an hour. So when we typically, because we predominantly focus on property, short-term investing is anything up to 18 months to 2 years. Anything on a longer aspect is looking at probably 2.5, 3 years onwards. So your standard buy-to-let, so your HMO strategies. And then looking at retirement, I've got investors that look at that in a couple of different ways. Me personally, I'm utilising both pension. So I'm starting to build a pension pot as well as using ISAs. So a lot of people think ISAs are just for today or just for short-term investing. But if you can build that up over time, you can start to draw down on that whenever you like, whatever amount you like, and it's completely tax-free. The drawback with that, opposed to building pension pot, is that it's on monies that you've already been taxed on. So it's monies that are in your personal name, and then you put it in. So many investors have many different things, and that's one of the reasons when we're discussing this of keeping it completely blank, but having a mindset when you're setting your goals as, right, this is what I want within the short term, this is what I want in the longer term, and this is how I'm going to plan for that retirement.
Yeah, absolutely. So, we're going to share these this video after this call as well. So, if you are in the stage now of looking at what your plan is, looking at what the investment opportunities are for the new year, then things like this are really key to making sure you've got the right balance within your portfolio as well. Ask yourself a couple of questions when you're doing that kind of preparation. So, how diverse is your current portfolio. If you're brand new to it, then great, you've got a completely open, fresh page book, if you like. If you're already investing, John mentioned earlier that he's looking at his portfolio and actually thinking, wow, I'm spread across so many different things. Does this make sense, or does it make more sense to actually have a more focused area, particularly in the stocks and shares? We get some investors that come to us and look to invest. As an example, from our side, from the platform side, some that will come to us and look to invest a large proportion of their investment pot just in our platform, whereas then we'll sit down and explain, well, actually, you need to have this balance, you need to be diverse to make sure that de-risk your situation. In the same way as well, one of the questions that you should be asking yourself when preparing your investment plan is how much of your portfolio or your investment plan is passive and non-passive, because how much time do you have to invest into this? A lot of people when they're starting off particularly investing, they always go for the route of, I'm happy to put the time in to get the returns, but doing a full-time job and managing investments is very hard work, particularly if there's a family in the mix as well. Suddenly it starts to take over. You do typically get to a stage where actually you sacrifice some of the return because you want it to be more passive, and that's quite natural. So if you're at that stage now, don't beat yourself up too much about it. That's quite common with investments. But these are sort of questions that you can sit back, ask yourself and say, right, okay, where is my portfolio? What am I invested into? What's passive? What's non-passive? What's taking my time? What's giving me the return, to make sure that you're utilizing it as much as you possibly can. Becoming more and less diversified. So it's really interesting, this one, because I think the past 5 years, when we've done webinars and when we talk to people about investing, we constantly talk about being diverse. You've kind of kicked it off, John, by saying, well, I think I'm too diverse, particularly in the stocks and shares sector. So, where is that balance? At what point do you say, well, I'm either too diversified in investments, or, I'm not enough? What is there a magic number?
I think it's that sweet spot for what your risk tolerance is, what you want to be educated in, what you want to know within a particular asset field that you're in. And for me, I've kind of lost track of where my stocks and shares investments are, because I've got so many and it's so varied, and I'm managing it day to day. Well, I say day to day, probably month by month now. I've kind of let it simmer as the stock market's declined. So whereas if that was with a managed fund, or if that was in a portfolio that's being managed on my behalf, or if it's in less stocks and shares, it'd be a lot easier for me to keep a focus on and know exactly what's happening. So that's one of the reasons why next year I want to try and slim that bunch down slightly, remove the non-performing assets, and just target the ones which I'm more comfortable with. So again, I can keep it passive or put it into a managed fund and have a little bit more focus on it, while staying diversified to a degree, but not as far as I currently am on that. But one person's diversification might be completely different to another person's. So one investor might just want to buy one buy-to-let property, whereas another investor might want to be spread across stocks and shares. They might want to be spread across third-party loans, similar to what we do on peer-to-peer. They might want fine wine, they might want art, they might want whiskey, etc. So it's completely different per person, and that's kind of how we've left this webinar, as an open-ended discussion, more than you must do this, rule number one, blah, blah, blah. So it's more of what you're happy with and what you're comfortable with, and making your portfolio as that.
So when you talk about being too diversified, ultimately it's what's manageable, I think.
From my point of view, yeah, absolutely. And from other people's point of views, it might be that they've got 6 different managed funds, and it might be that they're paying fees with every single fund manager, which is a flat fee. So it could be that they've got too much diversification because they've realized that the fees year on year on year are all building, whereas they could be with 2 different fund managers that are effectively offering the same outcome with the same stocks and shares that they're invested into, without paying so many fees. So again, it's not just having the ability to be on top of what they're doing, it's also knowing where your funds are being utilized, and how much fees, if you are paying fees, that they're amounting to.
Yeah, absolutely. Fantastic. Cool. Hopefully that's given everyone an idea. If anyone's got any questions, queries about that, then feel free to jump in, guys. Anything that you want to sort of understand a bit better. Starting your plan. So looking at, the new year, what do you do? What do you invest into for 2023? Start with a health check. So John mentioned at the beginning, so new year sort of clean up, what can I get rid of? What's not performing? What is performing? Media diet. I think this is a really cool one. And I think it's becoming more and more popular. You hear a lot of people who kind of deleting social media for a period of time to get a focus. I don't think you need to go to that extent, but it's actually identifying the media outlets that are giving good, honest, transparent information and data so that you can make informed decisions rather than just someone's making a lot of money off the trade market, the stock market, etc., and following that, what they're trying to do. Current portfolio performance. So again, not just part of the cleanup, but looking at the overall performance of everything. Educating yourself. So part of the thing that we're presenting with this webinar is we're offering a free book at the end for anybody who's interested. But for us, it's it's one of our investors who's actually written the book. The key benefit of the book, it's great information, great story, how he's kind of gone through the investment, learning about different investments, but also the due diligence side of that book is, for me, absolute dynamite. So there's a due diligence checklist for investing into, in particular, types of loans that we offer, which is great because if you're new or you're still kind of working out what works, then it's great to actually get someone else's due diligence checklist to say, well, actually, if I missed this, or can I add to this? And you don't often see these in the sector when investing. For what should you be checking for? So that's really good from an educating point of view. Fee review. So touched on what you've just mentioned, really, John. The fees. Quite often, so many times we speak to people, and they're achieving a return of 9%, 10%, 11%, but they're paying fees. So, and it's not really, they're only looking at that kind of gross headline figure. They're not looking at actually, what am I coming away with? What is my money actually earning? Because you've got to take away 2, 3, 4% in fees. With ourselves, just to kind of throw it in there, we don't charge our investors zero fees to invest. On the returns, the return's fixed. So ultimately, for us, it's a massive step forward. It's transparent, it's open. And I think there are a lot of other platforms that are taking it on board, and it's important to find them because, particularly if you're using a platform to just help manage certain areas, there are a lot out there that are a lot cheaper, or you can consolidate what you're doing as well. So that's kind of a health check of where you are, what you're going to do, and obviously push things forward. Taking a step back, when you've kind of put your plan together, question your understandings, always look at, okay, yeah, I feel like I've got a grasp of where this is going to be invested, what I'm going to expect back, what can happen with that though. Look for evidence in market with market leaders. So as an example, again, talking about gurus or people that you're following, actually, can they evidence what they're achieving? Can you see it? Can you go online and check it? Is it company's house? Those sort of things. Speak with like-minded people. So I mentioned before, I've had calls today with investors. I've got calls booked in tomorrow. 5-10 minute chats, just with people that are in the same kind of headspace, looking to achieve the same sort of thing, working together, sharing ideas. It's where we pick up a lot of our information as well, because it's great, listening to what our investors are doing and what they're achieving. And then questioning your due diligence when you come to that stage of, right, okay, yeah, I know what the strategy is going to be. I know how to invest, understanding, have I covered everything? Is there anything extra that I could do? Due diligence doesn't have to be ridiculously long. It doesn't have to be a drain, but it's making sure that you've got that tick list, you've checked the important points, and you're covering yourself. You're as secure as you can be, and you're mitigating as much risk as possible. As I mentioned before, the book that we're going to share, some great checklists in there, some great information in there as well. So one of the areas people are always excited about is looking at how they can invest and be more tax efficient. I think we've got a poll here, so I'm going to fire this out to everybody while we're chatting away. But yeah, so 2 ways. I've fired the poll out, guys. So 2 ways that you can be tax efficient with ourselves, and I'm sure this in other sectors as well, but we're talking about our kind of experience. So we've got an IF ISA. So if you can invest up to £20,000 per year in your IFISA. With that, with ourselves, you can invest that into our peer-to-peer lending platforms, and then the results, the returns are tax-free. You can also invest for the SAS pension, and that kind of gives you a good, a tax-free investment opportunity as well. While this poll's taking place, I don't know if you want to expand on that, John, and a bit more information about, how I suppose savvy investors are utilising this, and ultimately looking for ways that they can save that extra tax to get the full return as much as possible.
Yeah, it's a government incentive for investors to invest up to 20,000 per tax year with an ISA to be for the returns to be completely tax free. You can start to build that up over time, and I've got a number of investors that have done extremely well through investing with ISAs, and they've built up a sizable pot now. So many investors that I speak to when they're new to IFISAs or ISAs in general, they believe that it's quite limiting because you can only put 20,000 in. So they think that year after year, that 20,000 is your ultimate pot that you can use. Whereas if you build that and you get a return on your investment, and then you put in another 20,000 the year after, you can build that pot pretty quickly to a sizable amount, and the returns are completely tax-free. And that's one of the methods of investment, or the vehicles that I'm using, just to be able to every year move some of the cash investments into ISA investments. Again, the year after, move more cash investments in. And other ways to do it, similar to what I mentioned with the pension pot, is start to look at relief at source and putting monies into your pension to be able to invest that as well. Over time, build that pension pot. The returns, again, that's completely tax-free.
Fantastic. We just put a quick poll out there, just asking if anybody wants a bit more information about the IFISA. So we've got there, which is great. One of the things I'd say as well, if anybody's interested, we've done a video in the past about becoming an IFISA millionaire, and it's a kind of eye opener in terms of actually, by being tax efficient and using compound interest, which we'll jump on shortly, a great way to build your ISA to become an IFISA millionaire. So if anybody's looking for that, then feel free to message us at the end. Happy to share that information and share that with everybody as well. Not a problem. So yeah, also looking at next steps. So sorry guys, lost there. Talked about compound interest. So we touched on this in our last presentation, and it got quite a lot of questions and feedback. So happy to jump onto this one again. Let's just share with it if anybody's not seen it. So that the process and understanding of this is, when you invest, then on your next year investment, the interest that you've generated is then invested as well. And then looking at how powerful that is in terms of, if you continue to reinvest that interest along with your initial capital, actually what that balance grows to. So you can see here an initial investment of £50,000, return builds and builds, then we hit the 20-year investment. Now that's only £50,000 been invested. The rest of it is interest, but it gets you to a figure in 20 years of just under £500,000, which is absolutely massive. I know there are famous quotations around compound interest, talking about how it's kind of like the eighth wonder of the world, and just how powerful this is. And it's 100% right. A lot of our investors utilize this with ourselves, love it, love the fact that their interest is then making interest, and that's making interest. It's a really powerful tool, and it's something that when you're planning your long-term investments, make sure that you can utilize this as much as possible to get the absolute maximum from it as well. Anything you'd like to add on that, John?
No, you've pretty much hit everything on that, really. It's quite simple once you get to understand it, and using calculators like this allow you to see exactly what that investment rolled over year on year starts to do. And it's amazing when you start to calculate it and work it back and actually start to see the results as well. So if you look at the accrued interest on that last slide, it was 430,000 over a 20-year period by just investing 50,000 and receiving 12% returns per annum.
Yeah, which is scary stuff, which is great. Fantastic. Involving yourself in the sectors. So if there's a particular sector you're interested in, or different assets that you're interested in, make sure you sign up for investor alerts, forums that you can join and download further information. Networking events are great things to go along to understand a bit better. learn off people's investments, experiences, what they're looking to achieve, and also trade shows as well. So you can meet a lot of the experts, a lot of what their thoughts are. Typically at trade shows, you've got kind of panels of experts there as well, which is great to share. So look at ways that you can get involved in spare time to educate yourself as much as possible. I mentioned at the beginning about the book, so investing in property development loans. It's a great book by one of our investors, Andrew Singer. At the back of the book, you've got this really good and really useful due diligence checklist. So if anybody's interested in a copy of the book, then please drop John an email, john.wilson@source.co, and we'll fire that over to you. So you've got a copy of that as well. But great read, regardless of where you are in your investment stage. It's really helpful. There's lots of really good golden nuggets in this, so definitely worth getting a copy of it. Key to review. So making sure that when you've put your plan together, you've got a monthly review or a quarterly, or certainly every 6 months. Look for investments that offer transparency and updates as well. I think that's really important. So the feedback we get back on our platform is, so if you invest into one of our loans, our property loans, we share the reports every 4 to 6 weeks from the managing surveyor to make sure, so you're fully aware of what's going on with that investment, where it's up to, and what the timescales are. So being transparent is really, really key in that way. Don't be afraid to change your strategies. If things are changing or the market changes, don't jump straight into it, but have a view. Don't be too scared of actually doing that. Some people will hang on a little bit too long, but really good points to kind of cover when looking at review. So we've kind of covered different areas of building that plan, what to look at for investing in the new year. We'd like to give you a bit more introduction into Source Capital. I'm going to pass it over to John so we can give you a bit of information about how our investors work with us and the returns that they typically generate on the back of this. Over to you, John.
Thank you. So yeah, it's good to see so many new people on the presentation. Usually we'd fly through this. We've got quite a lot of current investors, but I'll run through what we do and how we do it. We're a peer-to-peer investment platform that's regulated by the FCA, and we offer property development loans within the UK. So it's a way for you to invest into, as I mentioned before, short-term investments, anything from 6 to 18 months to invest, earn a return, and it's completely hands-free and passive. So if you flick through to the next slide, Steve, we'll run through a little project, and Steve is a developer on this. So as I mentioned, we're a peer-to-peer platform which is regulated by the FCA. We purely deal with UK property developments, and so far to date, we've got a 100% repayment record. That is of all capital and expected interest for our investors.
Fantastic. Yeah, this is the project, John.
There we go, perfect. So a CGI there of what is similar to the building. Currently it's in a bit of a need of repair on the outside, but it's a 32-bedroom hotel, which is being converted into 13 two-bedroom properties based in the heart, effectively, of Scarborough, right on the seafront. So the total loan amount that we're raising is just over 1.6 million with a GDV. So anyone who's watching that doesn't know, GDV is gross development value or done up value, what the property will be worth once the works have been completed. And then the amount that's being borrowed for that or against that GDV becomes our loan to GDV at 60%. The investment is a 18 months project. So it's 10 months to build or 10 months to refurbish or convert, depending on which way you look at it. And then it's 8 months to sell those properties, which will be sold to investors, utilising overseas and UK-based investors to purchase those properties. Investors will receive up to 12% per annum for anyone who invests into the project. You can do that through a pension, a SAS, a company, or you can do it through an IFISA or just a regular cash investment. And the loan security, as with all of the loans with Sourced Capital, it will be a first legal charge. So that's similar to what a bank would have over a property if you've got a mortgage. And we've done webinars in the past, and I don't want to delve too much into the technical terminology. However, feel free to send me an email or give me a call, and I can run into what those terms are and how they actually work with an investment. Additional loan security will be a personal guarantee offered by Stephen Moss, There'll be a company debenture over the SPV that's been created. There'll be borrowers' equity into the deal. And with this deal in particular, Stephen inputted further capital to make that investment more attractive to our investors. And there'll be collateral warranties as well in place.
Fantastic.
So
yeah,
oh, go on, Steve, sorry.
Sorry, mate, I was just going to say, obviously, if anybody's looking for further information about the source capital, the project, we have a due diligence report, credit report, which is very detailed about the project. It goes into a lot more detail, obviously, what we can cover on this webinar. John mentioned earlier that he's happy to share that. I've just put your contact details up on screen, John.
Perfect, yeah. So that's my direct phone number. I'll be doing little bits of work over the next few days, little bits, I say, jokingly, and obviously you can email me and I'll send through the credit report. I'll send through information about who Source Capital are, and I will be reaching out to a number of people on the webinar, which I'm already familiar with. So any questions, any queries, just let me know.
Fantastic. Yeah, we kind of just want to tie up there, really, guys. I think we're just run over slightly, so apologies, but thank you for bearing with us. Thanks for joining us between Christmas and New Year. Hopefully you've picked some tips up there on building your investment strategy, what to look for the new year, any ideas and suggestions. We've got a great investment opportunities available there, which John's happy to share further information. If there's any information you'd like about a particular slide or a method that we utilize, then feel free to reach out and we'll send that information over to you. Have a fantastic break, have a lovely new year, and we look forward to sharing more information with you in 2023. Take care, everybody. Thank you.
Perfect. Thanks, everyone.